Thank you so much for joining us. Please give a warm round of applause for our panelists. We've got Alfonso Peccatiello, Mike Green, Jurrien Timmer, and Danielle DiMartino Booth. Let's do it. Our co-founder, Mike, just spoke beautifully about the connection between Bitcoin and macro, and crypto and macro, I should say. And we're not saying that the reason that the NFT you bought, that it went from $10 to $10,000, it's not because of Jay Powell, but the connection between the Bitcoin and the Nasdaq is quite high, and sort of the worlds are really colliding. The first question I want to ask for our panelists is, what is the biggest dislocation in the market right now? Which asset do you think is the most mispriced? Danielle, how about we start with you and we'll go down.
Right now, because you gave me time to think about this, you gave me homework. I think multifamily is. There's about 19.7% of multifamily right now is on a special servicer watch list. That is so dislocated from the current default rate, it's not even funny. Multifamily, especially urban, has been built around the notion that the office ecosystem would remain intact. And from everything that we're seeing, the office ecosystem is collapsing. So.
Thank you. Jurrien?
If you'd asked me this question yesterday, I would have had a more provocative answer. Am I on?
Yeah.
But after the CPI report today, I think that the biggest mispricing is the market's complacency about where the Fed's going to go. Real rates are at the long end of the curve, as measured by the TIPS market, are about +0.5%, +1%, which is getting to be interesting. But at the short end, if we look at R-star, the natural rate, which I measure to be close to 1%, that's a real rate. The Fed, based on where the TIPS market is right now, is expected to not even get to that point, based on current expectations of about a 4% terminal rate. So for me, a useful indicator has been the 2-year yield as a measure for the full extent of the Fed cycle. And based on the 2-year yield's inverse correlation to the S&P's price to earnings ratio, S&P belongs at around 14 times expected earnings. We're trading at around 17 times. So to me, that is a big disconnect, because that would suggest S&P around 3,300, assuming that earnings hold up, which is another big question mark.
Thank you, Jurrien. I should say 30 minutes before, about an hour before, U.S. inflation came in at 8.3% year over year, and increasing Fed hawkishness or higher rates was priced in the market. So now the market sort of thinks the terminal rate, or how high the Fed will go, will be about 4.2%, which is quite high. Mike, what do you think is the biggest dislocation in the market?
Well, part of me would echo what Danielle is saying, which is if I look at the real estate markets, in particular commercial real estate, we're seeing an extraordinary degradation and a realistic appraisal that we're never going to fully go back to the office, right? Under that framework, we're seeing vacancy rates anywhere from 30 to 50%, depending on the location. San Francisco is currently running 70% vacancy. The reason why we're not seeing those rents repriced, we're not seeing those properties repurposed, is largely because of the debt contracts that they're under, right? So if you lower rents in many commercial real estate properties, you actually are triggering a violation of your covenants that can cause a repricing, and as a result, things are not clearing in any way, shape, or form. So I would push that, and then the second area that I would highlight is an associated component, which is just heavily levered equities, which we're actually seeing the credit markets suggest that there's much more distress than we're seeing in the equity markets.
Thank you. Alf?
I'm going to go with, am I on? Probably,
Yes.
I'm going to go with the equity market. I think the S&P 500 belongs in the 3,500 area or below. The reason is very simple. We basically had in 2020, 2021, the largest injection of money into the private sector ever, at the fastest pace ever across global markets. That's being withdrawn right now. Money is not flowing into private sector, it's being taken away by governments. And the second is the other policymakers, which is central banks, are making their best effort to break inflation's back. They're not going to stop until inflation is back at 2%, not 4 or 5, but at 2% in order to regain credibility. That means tighter monetary policy and tighter fiscal policy, which is not reflected either in earnings nor in valuations.
Thank you, Alf. So yeah, the Fed and other central banks are hiking interest rates, tightening monetary policy into a recession, or at least into a period of slower growth. Danielle, I want to ask you, why does easy money create buoyant asset prices in the first place? So we all know, that everyone says the Fed printed so much money in 2020, that's why asset prices went up. Now the Fed is not printing money; they're tightening policy. That's why risk assets have had a tough time this year. To what degree do you actually think that's true, and sort of like what is the mechanism by which that sort of happens?
So to the extent that the Fed actually pulls paper out of the market, and the money that is created is invested in something else, and that is part of the channel. It's not that predominant part of the channel, but it is part of the channel of QE. To that extent, there's a direct transmission mechanism. But more importantly, more broadly speaking, I think there's a confidence. There's simply a confidence in the Fed. Think of the persistence of the bear market rallies. Think of the assumption that investors are operating under. Look at my Twitter feed. I mean, I would say 98% of people say Jay Powell will pivot again. And there is an ingrained belief, and until that belief is dispensed with, I think that the Fed will constantly be pushing up against a credibility crisis.
Thanks. Jurrien, you're deep in the institutional world. How have you seen the viewpoint of the Federal Reserve, like forward response function, change? Because at the beginning of this year, everyone thought, a lot of people thought that the Fed wouldn't hike at all, or if they would, it would be, a sort of flash in the pan. How have people adjusted, if they have adjusted at all, to the view that the Fed is going to be, higher for longer?
Yeah, well, I mean, we see that the first 8 months of this year, we've had neither the 60 nor the 40 part of a 60-40 portfolio do very well, and that's being very, very generous in my statement. And basically not anything has done well, including crypto. And so that, I think, is a reflection that the old formula doesn't work. The Fed put is either gone or out of the money, and the Fed has not had to deal with an inflation problem, for a long, long time. The financial crisis was really the last time we had any kind of real inflation. So when the Fed was, normalizing policy back in 2015, 16, 17, 18, inflation was not a problem. And so ultimately in 2018, the Fed went a bridge too far, and we were at a 2 handle back then, and the market, had a tantrum. S&P fell 20% in the fourth quarter of 18, and the Fed immediately pivoted. And maybe that's another conversation for another time, but it shows you that the Fed recognizes that its policy tools, full employment, price stability, generally are being managed by looking at backward-looking indicators, right? Inflation, employment, and that's why in the history of the Fed, and certainly Danielle knows this better than anyone, Fed tightening cycles have led to so many recessions because they're always looking in the rearview mirror. That's why the modern era Fed has started to look at financial conditions as a bridge from the real economy to the markets. And so stock prices, credit spreads, interest rates, the dollar are all components of that. And I think that's a very useful thing because you're looking at real-time data instead of backward-looking data. But the risk is that you then are listening to the wrong signals, right? So you could argue in 2018, yeah, so what if the S&P falls 20%? Why is that so bad for the economy? And so I think the Fed is learning from that. And of course now inflation is a persistent problem. It's not the transitory thing that they all thought it was a year ago. And the Fed needs to maintain its credibility. I would say it still has it. You look at the TIPS market, it suggests that inflation will return to normal in the coming years. But the Fed needs to maintain its credibility, and therefore it needs to stay hawkish. And the irony is that as soon as the Fed starts to say to the market, it's like, okay, I think you've got it, 4%, 4.25% is about where we're going to go. As soon as it says that, markets are going to rally because they're going to look past that pivot, past that turn. And then guess what happens to financial conditions? They start to ease. And then that undoes whatever the Fed is trying to do. We've seen that several times already this year. So the Fed is going to have no choice but to really beat everyone over the head with the hawkish message until the very moment that it actually does pivot. And so it's going to be a very binary opportunity set at some point in the next probably year or so.
And just to punctuate your point, if I could, it doesn't matter what they say. Markets just don't believe them.
Well, when you say that markets don't believe them, what do you mean by that? Are you referring to the level of the S&P, or are you referring to
The
what's
presumed
priced?
pivot.
So I'm not sure that I'm not sure I would read it the same way. I look at the presumed pivot, and really it's just saying, okay, here's a terminal rate, and from that point it becomes a decision point. Where do we move, right? If you hit a terminal rate and you expect that at some point that's going to reverse, our discussion isn't so much around, will there be a pivot, right? Because nobody in their right mind actually thinks that they will never lower interest rates again. It just becomes a stochastic distribution that says, a year off into the future, we're going to start cutting, right? And we've actually saw that today, where the front end moves higher and 6-month forwards in the same market are rallying, right? They're suggesting that the Fed is going to hike until it breaks something. I don't think anybody disputes, certainly not at this point, whether Powell is going to hike until things break. It's just a question of the market is saying, look, it's increasingly likely that it's going to break.
But to your body of work, the passive model structure has never been tested.
Yeah.
Ever.
That's what frightens me more than anything else, right? Is that we seem to be treating with alacrity the idea that we're going to remove the Fed put, that we're going to force financial conditions much tighter without recognizing the potential implications of that, right? So I continually hear from people that Fed monetary policy is not restrictive because they'll quote an 8.3% trailing inflation number against the 2.5 or 2.75%, Fed funds rate, and they say that can't possibly be restrictive. And then look at the world around you. Like, the housing market is imploding. The auto markets are beginning to implode. The ability of households to tap into marginal credit is beginning to collapse, right? We're seeing the stress. We're seeing the behavior. We have a theoretically super strong labor market that's printing negative real earnings growth, right? That's not a super strong labor market. So.
Thanks, Mike. Alf, I want to ask you, so the current financial conditions are relatively tight, much tighter than a year ago for sure, and forward interest rates, the terminal rate is about 4.2%. Is those financial conditions index, which is measured by interest rates, credit spreads, equity prices, and the dollar, is that tight enough to moderate inflation, or is there another leg up that has to happen, whether it's risk-free rates going up more, credit spreads rolling out, in order to really tame inflation?
There are two channels that normally achieve the transmission mechanism the Fed wants from tighter policy to the real economy. Tighter financial conditions work by the rate of change and the duration of how tight they are for how long. So the rate of change has been pretty relevant. We have seen credit spreads widening, not as much as I would have expected, but still they've widened. The dollar going up very fast, very quick. Interest rates in real and nominal terms also spike up. So those three components have surprised markets in the rate of change between November last year and, say, June this year pretty aggressively. So we have had that, but that's one channel that mostly surprises financial assets very sensitive to tightening conditions, right? So you have highly risk sentiment-driven asset classes reprice very aggressively on the back of that, et cetera. When it comes to the real economy, that's what the Fed is interested in. Right now, they want to see inflation slowing down, and they want to see the momentum of core inflation slow down. In order for tighter financial conditions to affect that, you need time. You need financial conditions to be tight for a long period of time. And in 2018, you had forward real interest rates, so the interest rate adjusted for inflation in the long end of the curve, let's say, being above 50 basis points, so meaningfully positive for 77 trading sessions before you saw, well, let's say, some serious stress in the credit market that led the Fed to pivot back in December 2018, January 2019. This time, the problem is that even if you keep real interest rates high for, say, 80 trading session or 100 trading session, the first thing you're going to see is more pain in financial markets. But you aren't going to be able to see immediately the same pain reflected in the components of core inflation the Federal Reserve wants to see slowing down. And that's shelter. Mostly it's rent of shelter. It's core services. They're looking in the rear view mirror, Jack. That's what they're doing. They're looking at housing. And actually, they're looking at rents. Rents tend to be a lagging indicator of a housing market that generally tends to lag a little bit the real economy. So you're looking at a kind of lagging indicator, and until they break the lagging indicator, they won't stop. So the answer to this question, to your question, is for how long financial conditions need to be tight. I think for longer than people expect. And it's a very weird setup where they're only going to stop where enough damage is done to the most lagging indicator of all. That's where we sit right now.
Thanks. You go. So the Federal Reserve has two mandates: stable prices, i.e., low inflation, and low unemployment. Mike and Danielle, can you speak to the degree that both of those mandates, the labor market and then inflation, are lagging? Inflation and the labor market. Can we start with you, Mike, please?
Well, so, I mean, this goes back to the points that a couple of other people have raised, right? I mean, if I look at a one-year inflation break-even, it's already at 2%, right? So the market is effectively saying to the Fed, mission accomplished. For exactly the reasons that Jurrien highlighted, if the Fed tried to say, well, we recognize that we've accomplished our mission, that would be interpreted as a loosening of financial conditions, which would likely cause that inflation break-even to begin to rise, right? So they're not going to stop at 2%. They think they're going to stop at 2% in the same way that, if you live in a tall building and the water heater is on the bottom floor and you try to adjust your shower, you go to hot and then cold and then you flip it back and forth, right? So these lagging components suggest that it's highly likely we actually end up blowing, by the time we stop this, that we'll end up blowing way through the 2% to the downside. We end up with deflationary conditions that then persist and create tight financial conditions regardless of the Fed's intention, right? So we're going to have tight financial conditions for an extended period of time that is likely to manifest itself in all sorts of problems that we have not yet begun to realize because this is still relatively new, right? Rents are a perfect example of this. Rents adjust when you come to the end of your contract, right? So if I sign a one-year lease, right, my rent doesn't go up in February, March, April, May, it jumps in December, right? And so we have this component of it can lag by, 12 months in any individual contract, and then we run across various other components and you end up discovering that it can lag by 18 to 24 months. What we're seeing right now is the flip side of all the outcry that you heard last year about, the Fed's metric doesn't capture inflation in rents, and, this is the Bill Ackman nonsense that was being floated last year, right? We've got rents rising 12% and the Fed doesn't show it in shelter. Well, now we actually have rents stagnating and beginning to actually decline in some markets. And of course, we're now getting 7% sort of prints in shelter. This is going to persist and continue, and ultimately they're going to end up breaking. Now, on the second component, which is what the Fed has articulated and said, they are very clearly saying their target is the labor market, right? They want to actually see, they explicitly have come out and said wages are too high. One, that's completely insane that the Fed is out there saying that, right? That's not their job, that's not their mandate, and the transmission mechanism between wages and inflation is unclear at best. For them to go out and actually express that is the equivalent of saying, yeah, we understand our target is full employment, but screw that, we really want to focus on inflation this time around. That is what they're doing. It's a disaster. It's going to create political unrest, would be part of my argument behind it, because people are really pissed, and they have a right to be.
Danielle?
I would agree with that. And in the current episode, I would say that if unemployment once was a lagging indicator because of the fiscal stimulus measures that were taken that pulled so many people out of the labor force, and because of the difficulty that employers faced securing employees, they're going to be more remiss than they would be otherwise in an environment of margin compression to lay off these employees that they tried so hard to get. So what was once lagging is now even more of a lagging indicator, and yet that is what the Fed is hanging its hat on. And we've got 4 million people out of the labor force permanently because of long COVID and a lot of other factors. The fiscal stimulus measures, the 25% increase in the food stamp program, which nobody talks about, which was implemented on October the 1st, it's keeping people out of the workforce who would otherwise be in the workforce. So it's pretty incredible how much more lagging employment is in this cycle.
The next question I want to pose is, do you think the economy is slowing? Do you think we're headed for a recession if we're not in one already? Do you think it would be a shallow recession or a deep recession? Danielle, let's start with you. I know you're looking at commercial real estate, multifamily housing, as well as the auto market, the plumbing of the banking system. So we'll start with you, and Jurrien, I want you to comment specifically on S&P 500 earnings as well, but let's start with you.
There was a lot of paper, there was a lot of commercial real estate paper written 2010, 2012. So for the past 2 years or so, we really haven't had a reset. That's coming now. So we're going to see that in the small and mid-sized bank area, and it's going to be really ugly. when it comes to cars, the best anecdata that I have is that people who would normally, for a plain vanilla recession, they would normally lease an overage lot to hold the extra repos. They're buying the property, just buying it outright. That's how long and deep somebody who's not in our world, not in macro, not an economist, just somebody who's like, damn, the volume's going up so quickly, I think I'm going to be sitting, because the lenders are hiding the paper. Because we had 130, 140, 150% loan to value car loans in the current episode, which is what we had last time with housing. And then you're going to see a trickle through effect because lending standards were loosened so much. Whether you're talking about credit card limits, you're at 88% of your limit right now. So people are running out of headspace. I would argue that we are in recession. We've been in recession since January. And with current GDP estimates where they are, 0.6%, my favorite guy, for Q3 on a level basis, which is how the National Bureau of Economic Research scores recessions, it looks like the third quarter, as things stand right now, before we get to the more slowing in the data for the month of September, that we're already underwater for a third consecutive quarter on the level of GDP. We do not score recessions on growth rates. We score them on level of economic output.
Thank you. Jurrien?
So I think we are solidly in late cycle with a significant risk that at some point, maybe in 2023 or even later this year, there'll be recession. And the way we think about it, we score the business cycle into 4 quadrants. So you have a downturn, right? Things are the level is negative, growth is getting more bad. Then you have early cycle, things are still negative, but there's a recovery. So the rate of change is improving. That's where the bottoms are in the market. It's always on a rate of change basis. Then you have mid-cycle, which tends to be the Goldilocks sweet spot and the longest phase of the cycle. And then you have late cycle, where growth is slowing and inflation is accelerating. And by definition, that's where we are. And of course, late cycles are a very tricky part of the cycle because there's a lot of dispersion in outcomes in terms of length. And the market can do really well or it can do really poorly. So it's a very hard quadrant of the cycle to get right. But that's, I think, where we are now. And one of the questions is what happens, as you said, what happens to S&P earnings? So far, we've had a valuation reset, which should have happened, based on where the Fed's going and what interest rates are doing. The way I think about it is through the discounted cash flow model, right? So you put earnings growth or cash flow growth in the numerator, the discount rate in the denominator, and the discount rate has been going up a lot. And that lowers the present value of future cash flows. So far, this bear market, 22% at the low, has been all about the discount rate going up, thereby lowering the fair value of future cash flows. What hasn't moved yet is the actual cash flow, right? Second quarter earnings season is pretty good. 3/4 of companies beating lowered, albeit lowered estimates by about 4%. Fairly typical earnings season. In real terms, earnings, of course, are now negative, and the profit margin is coming down. It was 13.7. At the peak, it's down to 12.8. So all of these things make sense when there's inflation and slowing growth. And the question is, will earnings hold up? And it's interesting, when you look at history, the 40s, after World War II, or during and after World War II, as well as the 60s and 70s, earnings generally held up okay because earnings are a nominal concept, right? Companies sell into the nominal economy. But the corrections were all, or the bear markets were all valuation bear markets. And one of my favorite analogs is the post-World War II bear market from 1946 to 47, 26% decline in the S&P. Very similar backdrop to today, right? You had GIs coming back into the economy. The economy was kind of geared towards the war. It had to reestablish. You had supply chain bottlenecks. A lot of similar things in a different context, but similar types of imbalances in the economy. And the S&P fell 26%. It took 3 years to recover, and there were a bunch of false starts. But earnings never missed. But the valuation went from 22x to 6x. And I'm not suggesting we're going to go to 6x, but we were at 23x at the top. We were at 15x forward earnings at the bottom in June. We're up to about 17, 18 again. And based on my math, we should be at around 14. So I suspect that this will continue to be a valuation reset. But if the earnings are another shoe that will drop at some point, and I'm not predicting that they will be, it is a whole different can of worms. Because when you divide all the bear markets over time, going back 150 years, there have been 27 of them. Bear markets that were associated with recessions, the average was a 35% drawdown over 19 months. Bear markets that were just about valuation and not about earnings contractions had a drawdown of about 25% over 5 months. And so far, we're in that latter category. But if we do end up in a recession that really brings earnings down, then there would be that other shoe to drop still.
Thank you, Jurrien. Sorry if I can comment. So you said earnings is negative. So the S&P 500, it's still earning money. It's just earnings growth is negative on a year basis, right?
In real terms.
In real terms.
In real terms. Thank you. And so I think the S&P 500 roughly earning about $220 for one unit of the S&P 500. So with the 14 PE, that would be roughly 3,200. You're not forecasting that, but I'm sort of
expected earnings are 230.
230.
Times 14 is about 3,300.
3,300. Sorry, yeah, wonderful. Mike?
But you didn't hear it from me.
Yeah.
So I think this is one of the things that's kind of interesting about this, right? Is that when Jurrien highlights that sort of forward earnings expectation, one, that's growth in a period in which we're potentially saying there's a recession, which tends to be associated with contraction. The second component that I would broadly highlight about that is the degree of over-earning. So I look back at a 1946 cycle, for example, and would actually suggest that we have something very different. So in 1946, households did not have access to buying cars. They did not have access to buying houses. They did not have access to all these things. And they had pent-up demand and incredible amounts of savings that they had accumulated over time that was then matched by an incredible amount of government stimulus in the form of the GI Bill, et cetera. If anything, we're looking at the opposite scenario here, where we've had people pre-spend on dishwashers and houses and everything else, and the government is actually incredibly hostile to these dynamics. When I look at that 200, I come to trailing earnings at like 205. On a real basis, my estimate is that trend earnings are more like 135. Right, so we're somewhere around 50% over earning in terms of the S&P 500.
Mike,
that's a pretty crazy scenario. Now, I also don't see the exact same dynamic in terms of multiple contraction. I actually have placed less emphasis on that.
So, Jack, if I can ask Mike to describe a graph that you share that shows the 85th to 5th percentile historic moves in tightening cycles. It's a pretty incredible graph.
Yeah, no, I mean, what we're actually seeing is that we are below the bottom, effectively, of what you would typically expect in a tightening cycle. And that's because most tightening cycles are actually the Fed trying to slow an economy rather than an economy that most of us would broadly argue is already slowing, and the Fed is now exacerbating the condition, right? I mean, last year, it was very, very clear that they missed the indications of an economy that was overheating, failed to respond in an appropriate fashion. Most of us on this panel, I know, were critical of their decision to continue stimulus, particularly on the fiscal side, and for the Fed to remain overly accommodative. What appears to happen, and Danielle knows the personalities far better than I do, but what appears to have happened is that Jay Powell is now embarrassed, right? And he's pissed. And every single piece of research that's coming out from the Federal Reserve banks themselves are saying, everything we're doing is wrong, right? This is a mistake. And he seems to be basically saying, yeah, I don't really care.
You think that's accurate, Danielle?
I think that that's fairly accurate. I think that politics intruded into monetary policy to too great of a degree. And I don't think the man that's worth $150 million is necessarily staying there to get the public pension payout when he's older. So he's there for a reason. And he's been shamed.
And I think also they've gotten so many things wrong that maybe they're just nowcasting now.
Yeah.
I think they're just following the news at this point.
Thanks. I'd also just say, so in the US, nominal growth is still positive. Real growth is negative on an inflation-adjusted basis. That's why you've had 2 consecutive quarters of negative real GDP. That's why a lot of people are saying we're already in a recession. And the nominal rate of growth has fallen precipitously, but it's still positive. Alf, how are you seeing the economy? We can talk about the US, or we can go across the pond to Europe, where you follow it closely. What's going on over there?
I want to pick up my Italian accent and use that. Fair enough. So the situation in Europe is much more complicated than in the US, if I need to top it up. The very cheerful discussion we already had. There is a inherent problem with the structure of the Eurozone that we are all very aware of. There is basically one central bank setting monetary policy for 19 jurisdictions, and 19 jurisdictions working with different features, and everybody applies a different fiscal policy under the same umbrella of rules, potentially, but they are never really enforced. So when you have this kind of setup, you start from a fragile situation already. On top of it, you have an energy crisis, effectively. And there is always a release valve if you have an external shock in a jurisdiction. So I compare what's happening in Europe now to the typical emerging market external shock type of crisis. Emerging markets are generally dependent on an outside input, being the flow of dollars, being certain goods, being a certain external input. When that input gets strongly hampered, there is an external exogenous shock. And in that situation, which for Europe right now will be energy, where basically Germany importing roughly 30 billion equivalent of natural gas from Russia was able to generate up to 2 trillion of value added by the manufacturing economy, the manufacturing output. Right now, that 27, 30 billion import of natural gas just doesn't work anymore with the same economics. So when you get that kind of external shock that you can't fix straight away, because you can use the government balance sheet to shield the private sector a little bit, but you can't print energy, to say it in a very macro-populistic way. Yes. But it's true. You cannot get your sources of energy sorted out very quickly. You have an external shock where policymakers are faced with a decision. There is always a release valve that is either the currency, because the terms of trade are horrible, and that's what we have seen for the euro, that has gone down roughly 20% against the dollar in like 6 to 9 months. Or if you want to try and shield your currency by protecting the private sector and using the government balance sheet like the UK or Europe are now suggesting to do with price caps, the other release valve you're going to have is in credit, is in weaker links like Italy, Greece, Spain, European credit markets, etc., because you are giving leeway to the central bank to be tighter. By protecting the private sector, you're allowing somehow the European Central Bank to enforce a tighter monetary policy. But the tighter monetary policy just doesn't square with the dynamics I described before, with not only the public sector debt being very high in certain jurisdictions, but what we don't discuss enough in Europe is private sector debt, which is sky high in places like the Netherlands, Sweden, Nordics in general, that have effectively, instead of use the government balance sheet, they've used the private sector balance sheet, the housing sector balance sheet to expand credit. And so when you double mortgage rates in Europe, the same problem is going to occur as it is going to occur in the US from that perspective. And on top of it, the private sector still has some hard times ahead of them because of the energy crisis. So I didn't make anybody more cheerful than before. I guess it's fair to discuss.
So Alf, can you weave in just really quickly the fact that the structure of the financial markets has changed compared to what it was in 08 and 09 because you've got this explosion in capital markets as opposed to just being a pure bank lending?
That's correct.
Europe's changed.
Yes, Europe has changed a lot. There has been a huge amount of shadow banking, credit intermediation going on in Europe that just was there before the great financial crisis, but right now it's much, much bigger. I used to work for a bank until 9 months ago, and I can testify to the fact that while everybody focuses on public markets, on very visible, clear markets, there is a huge infrastructure of corporate treasuries, pension funds, insurance companies, so on and so forth, and more complicated players that have now become much larger and fundamental players, especially in the repo market in Europe. So when these mechanisms are shaken from the very layer and the foundation, some interesting stuff can happen. And in Europe, there is an inherent scarcity of good collateral. So while in the US, there is an abundant issuance of AAA liquid, deep repo market securities, those are treasuries. In Europe, that is not the case. Europe has the smallest AAA market as percentage of GDP in terms of AAA collateral, good stuff that you can post as collateral and get back some cash. It has the smallest percentage of AAA collateral to GDP across the biggest jurisdictions out there. There's basically only German bonds and some European bonds being issued recently, but there is not the future market behind these European bonds. So it's basically only German bonds. And last thing, and then I'm going to stop this rant about Europe with an Italian accent, which I think is interesting, is to see that 2-year German government bond yields and now 100 basis point through the comparable ECB deposit rates. So now think about that. If you have cash in Europe, you could park it at the ECB, say make a swap that makes it worth 2 years of ECB deposit rate, or you could choose instead to buy German government bond and get your hands on this collateral, this very scarce collateral I was talking about before. You're going to have to pay a premium of 100 basis points to get your hands on these German bonds. That's the situation right now.
Gotcha. Well, there's going to be a lot of AAA treasuries, so hopefully that will fill the supply. We're going to have to leave it there. Thank you so much for joining us, everyone watching. I hope you've learned a lot. I know I definitely have. And if you came to this conference to hear about parachains and the ETH merge, don't worry. This is one of very few macro panels, and all the panels forthcoming will be about digital assets. You should definitely follow everyone's work here. Alfonso's Macro Compass. Mike is a portfolio manager at Simplify. Jurrien Timmer is the director of macro at Fidelity. And Danielle DiMartino Booth writes for Quill Intelligence. Please give a warm round of applause for our panelists. Thanks so much.